stop what you are doing, because something just happened in the US stock market that has only occurred a handful of times in the last 100 years, and by the time this video ends, you are going to understand exactly what it means, exactly what history says happens next, and exactly what to do about it. I put a lot of research into this video. Real data, real history, real numbers from verified sources. And what the data shows is going to change how you think about this moment completely. Here is the fact that should shock you. On April 15, 2026, yesterday, the S&P 500 closed at 7,022 points, a brand new all-time high. The Nasdaq hit 24,016, posting its 11th consecutive winning day, the longest winning streak ever recorded. And Wall Street's biggest banks, JP Morgan, Bank of America, Morgan Stanley, all reported record profits this week, beating every analyst forecast. This is not a rumor. This is not a prediction. This is happening right now. And here is why this moment is so important that I made this video immediately. Stay until the end, because I am going to show you exactly what happened after every previous all-time high in market history, and the answer is not what most people expect. Let me start with the history, because the history is the most important part. Most people think that when the market hits an all-time high, that is the worst time to invest. They think the top is in. They think it is about to crash. They wait for a dip that may never come. Here is what the data actually shows. Since 1950, the S&P 500 has hit a new all-time high on approximately 7% of all trading days. That sounds rare, but the critical insight is what happens after those all-time highs. Research shows that when you invest at an all-time high versus any random day, the returns over the following 12 months are actually higher than average, not lower, higher, because all-time highs tend to cluster. Markets that are making new highs are markets that have strong fundamentals, strong earnings, and strong momentum behind them. The most painful myth in investing is this, that you should wait for a crash to invest. Because here is the truth. If you had invested $10,000 in the S&P 500 only on days when the market hit all-time highs over the last 30 years, you had outperformed someone who waited for dips nearly every single time. Now let me show you exactly why this all-time high is different from any other. There are 5 separate tailwinds all firing at the same moment, and this combination has not happened since the start of the longest bull market in history in 2009. Tailwind number 1, the Iran ceasefire. 6 weeks of war suppressed markets, pushed oil above 110, locked inflation high, and prevented the Federal Reserve from cutting rates. The ceasefire removed all of that pressure at once. Oil crashed 17%. Inflation fears eased, rate cut probability jumped from 35 to 60% within 24 hours. That is rocket fuel for stocks. Tailwind number 2, earnings season is exploding. Bank of America beat expectations, Morgan Stanley beat by 14%, reporting $3.43 per share against forecasts of $3.02. JP Morgan beat, Wells Fargo beat, Citigroup beat. When the biggest institutions in the US financial system all beat earnings in the same week, that is the market telling you the economy is stronger than anyone feared. Tailwind number 3, artificial intelligence. AI demand is not slowing down. ASML, the company that makes the machines that make every advanced chip on the planet, posted strong quarterly earnings driven by intense AI demand. NVIDIA is on pace for its 11th consecutive winning session, its longest streak ever. The AI revolution is still in its early innings, and the market is pricing that in. Tailwind number 4, Federal Reserve rate cuts on the horizon. Lower oil prices mean lower inflation. Lower inflation means the Fed can cut rates. Rate cuts mean cheaper borrowing for businesses. Cheaper borrowing means higher earnings. Higher earnings mean higher stock prices. This chain reaction is now officially in motion. Tailwind number 5, Wall Street forecasts targeting 7,700 to 8,100 by year end. Ed Yardeni at Yardeni Research targets 7,700, a 10% gain from the current all-time high. Deutsche Bank targets 8,000, a 14% gain. Other analysts target 8,100. These are not random guesses. These are earnings-based targets built on corporate revenue data that is already coming in above expectations. Now I need to give you the honest picture, because this is where most financial content fails people. All-time highs are exciting, but they also carry risk, and you need to understand both sides. The risk side, valuations are historically elevated. The Shiller PE ratio, a measure of how expensive the market is relative to long-term earnings, has only been this high twice in history, once before the dot-com crash and once before the 2008 crash. This does not mean a crash is coming. It means the market is priced for perfection. If earnings disappoint, if the Iran ceasefire collapses, if the Fed cannot cut rates, the market can reverse sharply. The ceasefire is a 2-week truce, not a peace deal. Talks are ongoing in Islamabad. The situation remains fragile. Any breakdown could reverse some of these gains quickly. So here is the framework I want you to take away from this. This is not a video telling you to put everything you own into the stock market today. This is a video telling you to understand what kind of moment this is and to make decisions based on knowledge, not emotion or fear. Here is the intelligent framework. Step 1. If you are not invested at all, this is the time to start. Not because the market just hit a high, but because you should always be invested. Waiting for the perfect moment means you never start. A simple, low-cost S&P 500 index fund gives you exposure to every one of these tailwinds automatically. Step 2. If you are already invested, do not panic sell because of all-time high fear. The data is clear. All-time highs are not the end. They are often the beginning of the next leg up. Step 3. Do not put in money you cannot afford to lose. This is a fragile geopolitical moment. The ceasefire could break, earnings could disappoint. Always invest only what you can leave invested for at least 3 to 5 years. Step 4. Watch the sectors. The biggest winners right now are technology, led by AI, financial stocks, led by record bank earnings, and travel and airlines, recovering from the oil shock. These are not random picks. These are the sectors with the strongest fundamental tailwinds. Let me close with the number that matters most. The S&P 500 in 2009 was at 676 points. Today, it is at 7,022. That's a 900% gain in 17 years. The people who invested in 2009, when everything looked broken, when the news was terrible, when every headline said the system was collapsing, those people turned every $1,000 into over $10,000. Right now, the news is not terrible. The headlines are not predicting collapse. The market is making new highs and every major earnings report is beating expectations. The conditions in 2026 are not identical to 2009. They are better. Understanding that, while managing the real risks that exist, is the difference between financial education and financial noise. Comment historic high below if this video changed how you see this moment. Subscribe because I do a lot of research for every video I make, and the next one covers exactly which sectors and assets to watch week by week as this develops. This is the channel for people who want the real picture, not the comfortable one. I will see you in the next one.